presentation contains current opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Moe.
Hello everyone, and welcome to the Compak Asset Management YouTube update for November 15th, 2022. I'm Moe Ansari, President of Compak Asset Management and host of Market Wrap. So let's start with the markets, see what we want to talk about. Obviously the Fed, that's what we have to talk about, but we also have to take a look at what is going on with inflation. So we'll take a look at that. The market, we had one of the best weeks in the market since the economy has started to go down. That is in 2020. So in nearly 2.5 years was the best week. And that is why you don't want to be all in cash, because if you miss one of those weeks where the market goes up 10%, the Nasdaq, now you're just playing catch up, and you never will. That's why you have to have the right degree of risk always in the portfolio, a diversified portfolio where you know that yes, markets are down, but you are still down a certain amount this year as the markets are down, but you are coming back up. But if you miss the snapback, when we do get these snapback rallies, that's where the problems come in. Talk a little bit about the economy, take a look at the technicals, and look at the week ahead. So let's start with the Fed this week. The Fed increased its target rate last week, that where they're going to peak out, and it's somewhere around 4.75 to 5.25 is what we're looking at. The rate went up to 3.75 at the last meeting now. So where do we go from here? The question is, do we raise 50 basis points in December? And that is the expectation now. There's about an 87% probability that the Fed is only going to raise 0.5%. If the Fed raises 0.5%, what that means is that they're starting to take the foot off the brake. They're not on the accelerator. They're not back to neutral yet, which will be what is called peak rate, but we're not there yet, but they're slowing down the rate of increases. And as you've seen, and if you've come to the webinars, you've seen those, we see the market take off long before we see a peak in interest rates. We see the market take off long before we see a bottom in the economy. That's where the market sniffs out where the bottom is coming, and then it takes off. The economy continues to go down. We continue to see interest rates usually continue to go up, but the market starts to go up because it is anticipating what will happen or what could happen in the next 6 to 9 months. That's what we're seeing. Why the market went down so much over the last 6 to 9 months? I think what we saw was the market anticipating that the Fed will continue to raise rates. This is the expectation. December is 50 basis points. And if we're looking at about 25 in February, and then we might get one, might not get one in March. This 50 and this 70, this 50%, 0.5% increase, and then a 0.25% increase right here should do it for the Fed, depending on how slow the inflation number gets. We saw the inflation number last week, 7.7%, a lot lower than expected, one of the biggest days in the market on the upside, and we have held those gains over the last couple of days, which is a very good sign technically for the market, but we have to get above some of those technical resistance areas. The same place that we failed in August at 4,300, that same technical indicator, we're getting close to that again. Will we surpass it or will we fail again? We'll take a look at the charts a little bit later on. The market, again, 5-year bond market has turned down the rates here. So that is, the yields are starting to come down, anticipating slowing in inflation. Same thing, the possibility of 75 basis point is off the table. Yes, we're down to, it was 50-50 that the Fed would raise interest rates by 50, it was half, but now it's about 87% probability that the Fed is going to raise interest rates by 0.5%. Looking at the economy, the core CPI, we got the PPI today up 0.2%, again lower than anticipated. We need to get more. Next month we get the CPI again, and we get the unemployment data. One thing that we have not seen is unemployment go up. It seems like the Fed's brakes slowing down the economy is starting to take hold. That is by raising interest rates. That's what I mean by applying the brakes. The brakes are starting to hold. How much will this slow the economy? Will they bring it to a standstill? Will it put it in reverse? Or will we just slow down and take off again? We don't know the answers to that yet, but the market will tell us. We've just got to remain focused. Assumption of 0.3% inflation rate core. We see that you can see that it going down to about 4% by the end of this year, end of next year, 3.2% if we take a 0.2% core increase month over month. Again, Fed wants 2%. You've heard me for the last couple of years when you've tuned into the broadcast, that the radio broadcast, that I believe the Fed will let inflation run hotter, 3 to 4%. Even though the rhetoric will be, oh, we want inflation back down to 2, but they will let it run hotter. So I think they will not continue to raise rates if inflation is coming down to 3 or 4. You can see goods inflation has already started to come down dramatically. That is this blue line. But services inflation is still going up. That's what this mustard color line is. Why services? Airplanes, tickets, travel. People are still doing that, but I think they're getting to a point where they're running out of money. All that COVID money that was saved up is gone. We saw the amount of money that is the credit card debt is starting to go up now. So people have gotten used to spending, but they don't have the cash, so they're starting to borrow. That will only last so long before they will stop. Leading indicators for inflation suggest prices will ease in 2022. This is prices paid over a 6-month period. You can see the expectation, and you can see the CPI. It has finally rolled over. If you came to the webinars at the beginning of the year, we expected inflation to peak somewhere in June and July, and that's what we saw. There was a lot of hoopla that it's not going to come back, 40-year low, 40-year high inflation, and so on. It's starting to drop back. We need to have some unemployment go back up a little bit, and I think that'll really slow things down. Expecting unemployment rate in 1 year, again, that is still the expectation, that increasingly expect a weaker job market. That's what the consumers are expecting, but we haven't seen that yet. If unemployment starts to go up, believe me, the economy will slow down quickly. Don't forget to tune into my daily broadcast, Market Wrap with Mo. You can go to the Apple Store, just type in this entire Market Wrap with Moe Ansari. You can get the app. It is free. There's no cost, and then you'll get the daily edition downloaded to your iPhone. Looking at the technicals, interest rates. 10-year rates got up this high, came back down to the 20-day moving average. That's this red line, and then returned back up. Now we've left an island top right here, and rates are starting to come down. And today we got below the 50-day. Today we closed at 3.799. for the 10-year note. That's the first time we've seen it below the 50 days since right here, since August. Remember, that's where the market peaked in August. Interest rates started to go up. Stock market started to come down. Now interest rates, have they peaked? I don't think so. We'll have to wait and see exactly what plays out. Looking at the S&P 500, here's the daily edition. We're looking at it right here. This is where we failed at the 200-day moving average in August at 4,300 and change. Came all the way down to just below 3,500. Now we've come back up to the 20 days, if 200 days, 4076. We need to get above 4076 right here. This is support, fourth wave. This is wave 1 that we've seen, wave 2 to the downside, and we're in wave 3. But this wave 3 can extend, but we need to get above this 200-day moving average. We haven't done that since really the beginning of the year when we got below it. So if we can do that, that would be a very good sign, and that to me would basically say all the long-term systems will kick in and we're off again to the upside. Weekly charts again, the 20-week moving average, we have gone through that now, we're holding. Now we need to get above the 50-week, which is 4171, a little bit of a higher target. Nasdaq again, looks like it got to our target. This line's right here. It was our target, which was around 10.1. We got to 9,900. We got to 10,088. Now we're above the 20-day. That's the red line. Each one of these vertical lines is 1 day of trading, and you can see that the blue line. We're above that now, and we're heading towards 200-day. That's 12.2. We're at 13,370 358 today. We got about another 1,000 points to go in the Nasdaq. But today was the first time we saw the consumer, we saw the communication services, Meta, Facebook, those kind of, and tech stocks leading to the upside. I like to see that, more of that to the upside. Weekly Nasdaq, we're above the 200 week. We got above it last week on the close. Now we're sitting right here at the 20-week moving average. If we can get above that, then 12,284 turns our technicals to the upside. Well, as I said on the previous chart, that's really the 200-week-day moving average too. Crude oil fundamentals, it's stuck between China. Is it reopening, not reopening? We are going to put on Russian oil imports at the beginning of next month, and that could take some oil off the market. That's giving market, but it's really gone sideways, gone nowhere between 92 and 86. We get up here and come back down. And that's what I think it's going to remain until we see how much the economy is going to slow, if it's going to slow or not, how deep the recession is going to be. Is it going to be shallow, deep, or no recession at all? Gold has sniffed out something. You can see that it started moving at the beginning of last week. And you heard the daily broadcast on the radio. I talked about that. I said, look, the gold is telling us something. It took off on Tuesday before the CPI came out, and the market was up dramatically. I said, gold is a much smaller market, much more sensitive. It might be telling us that we might get a better than expected CPI. We did. And the gold market obviously continued to go up. After hitting this low close to 16, below 1600, 1618 was this low right here that we got to. And now we're going again towards the 200-day moving average, which is 1806. We closed at 1782 today. So it looks like all the markets are coming up for a test. Will they pass the test? We'll have to wait and see. That, I think, will depend on what the inflation number comes out next month. I think we're going to bounce around, go up a little bit, maybe get up to the 200-day, fall back a little bit, go up a little, and try to knock on that door a couple of times. But we need some fundamental impetus to get us through that 200-day moving average on the Nasdaq, on the S&P, on the gold market. If we do, that'll indicate that at least in the short term, we're going higher. Then we start looking at inflation's coming down, interest rates are getting closer to a peak. Then everybody will start looking at profitability. How much is profitability going to come down? But then the market has already made a bottom. If we're up to 4,000, we're up from 3,500 to 4,000. The market is already up 15%. People waiting to get that, they've missed that, and that's the problem. Again, don't forget to sign up for Moe's Market Minute. You can get my weekly update directly in your email box. All you have to do is go to compak.com and sign up. Looking at the week ahead, again, I think the markets are going to slow down. We're going to get into Thanksgiving week. So it's going to be a little bit slower next week. But I expect once you get past that, we should start moving. Those are my views. Those are my thoughts. Again, if you would like to get more information, want to see what we do, how we do it, or if you need help with your portfolio, just give us a call. All you have to do is dial pound 250 on your cell phone and say, talk to Moe, or go to the website compak.com. Thank you again for joining me this week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moe Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.